Good afternoon and welcome to another Tax Tuesday here at Mullen & Associates. Today we are going to be talking about something we see every year, and this is Roth conversions. So today we're going to go through how they can be one of the most powerful planning tools, but also it's an easy way to accidentally increase your tax bill if it's not done correctly. So tax law is not just about filing a return, it's about making decisions today that impact your taxes 10, 20, or even 30 years from now. You may have noticed Kathy is not with me here today. We're getting closer to the deadline, so she is handling a few returns there. And this is actually our second to last Tax Tuesday for this tax season. We have one today and one next Tuesday. We don't have a specific topic picked out for next week. It's just open Q&A. So any tax questions you guys may have coming up to the deadline, any planning questions, feel free to let us know. We'll be answering those. But on today's topic, we'll be talking about Roth conversions. So hopefully by the end of today, you'll understand how Roth conversions actually work, what the 2026 contribution and deduction limits are, how Roth converts it when they make sense and when they don't, but also what the One Big Beautiful Bill, the new tax laws for 2025 and beyond, how that impacts our tax strategy. And maybe we'll even go through an example of how to model this over a couple of decades. So think of this as your Roth conversion playbook. So starting out with 2026 rules. So in 2026, you're allowed to contribute $7,500 if you're below the age of 50. If you're above the age of 50, you get a little bit of a catch up. So not a large amount each year, but it does add up over time. For Roth contributions, naturally, there are phase out ranges. So married filing joint, once you get to $242,000 of AGI, your adjusted gross income, you're phasing out, and at $252,000 of married filing joint AGI, you are no longer able to directly contribute to your Roth IRA. So single filers, your phase out range is 153 to 168. So just be aware of that. For a traditional IRA, similar phase out ranges, but it's quite a bit lower. So 129 to 149 for married filing joint, 81 to 91,000 for single filers. So this does not mean you can't contribute to it. What it means for a traditional IRA is it means you don't get the deduction. So when you usually traditional versus Roth IRA, an IRA in itself is a individual retirement account. So you put money into this to support yourself in later years of life. So the two differences are traditional means you get tax deduction now, and then tax deduction now, and then it grows, and you have to pay taxes on the back end. Roth is the exact inverse. You don't get the tax deduction now. You pay all of your taxes on your income. You contribute whatever the net amount is up to that $7,500 in 2026, and it grows tax-free over the long run. So by these phase-out limits for a traditional IRA, if you're above $149,000 married filing joint income, you can still contribute to your traditional IRA. You just don't get the tax deduction for it. The downside is you also pay taxes on the back end. On any growth that may occur. So that's where Roth conversions really come into play. So if you contribute to your traditional IRA, roll it over to a Roth, you've already paid the taxes on that traditional funds if you're above that income. If not, you would have to pay the taxes. So that's really the reason why a lot of high income earners get stuck with large pre-tax accounts and why Roth conversions become critical later in life. So that is the goal. We want to pay taxes today. Sometimes, not always. So there's always a debate whether it's traditional or Roth is better. And usually it's a mixture of both. Ideally, we want to choose the timing of our taxes. Some years you may have a lower income tax year, great year to do Roth conversions. Other years, maybe you sold your business and it's a really high year, probably not a great year to do Roth conversions. So with the Roth conversion, the idea is you're going to pay taxes today and grow tax-free forever. But it's all about timing. So we're going to dig a little bit into that. Going through an example of what Roth conversions or Roth contributions in general. Let's say you contribute $7,000 a year at let's call it 8% return. Your total contributions over 10 years would be $70,000. At age 65, even just for those 10 years, you're talking $70,000 of principal invested, compounded for the next 30-ish years. You now have $600,000 to $650,000 in that account. So that's the power of a Roth contribution, is that is all now tax-free. You don't have to pay taxes on it. You can take it out. You can live on it. You don't have the IRS in your pocket in retirement. So that can be really, really helpful. Whereas a traditional IRA, on the flip side, you'd be fully taxable. So you've gotten the tax deduction on your $60,000, $70,000, whatever you contributed, $70,000 in this example. When you go to sell it, you have to pay taxes on all of those, all of the gains. Basically, anything in that account, you pay taxes on it. So depending on what your retirement account looks like, that could be pretty sizable, especially when you don't have control over how much you can take out of the account. Above age 72, 73, you're now required to take RMDs. So on that account, you may be forced to take a distribution, and maybe it's not a great year to take it. So it takes out a lot of that flexibility. So these Roth conversions, it's not always about saving taxes today, but it's eliminating taxes in the future, and it gives you more control. So when does it make sense? Roth conversions make sense in lower income years, like I stated. Before RMDs is usually the best way. One of the benefits of doing Roth conversions from a traditional to a Roth IRA is you lower the amount of RMDs. So maybe your RMD is planned at $100,000, but if you're planning 5-10 years in advance, you can take out some of that money, you can convert it earlier, and your RMDs become lower, which gives you more flexibility. It doesn't mean you can't sell off more, but you don't have to. So it gives you more flexibility in the long run. If you have a large IRA balance, this could be a benefit to you, or if you expect your tax bracket to increase in the future, whether that's your personal tax bracket or really just tax brackets in general. So right now we have fairly low tax brackets in the history of taxation. So it's very likely that they could increase in the future. But if your personal income, let's say you're at a 10 or 12% tax bracket right now, just due to your normal earning income years, and then you continue to compound that, and maybe in retirement you think you're going to be at a 22 or 24 or 34% tax bracket, you may want to do Roth conversions now, pay the taxes at a low rate. But if you're the inverse, maybe you're a high income earner now, and you're not putting a lot aside for retirement, and your income you think will drop down, maybe Roth conversions aren't the best for you. So the best time is really to convert when your tax rate is temporarily low. And I don't mean 1 year at a time. This could be 5 or 6 years in a row. When don't they make sense? If you're already in a high income bracket, if you need the funds soon, this generally doesn't pay off. If you need outside cash for taxes, or if, sorry, one too many slides there. Or if you're going to have a negative impact on thresholds. So that's a lot of what I want to talk about today is where these thresholds occur, especially with the One Big Beautiful Bill. Because a good tax strategy placed at the wrong time can become a very bad decision. We've seen that quite a bit where people just don't plan thoroughly enough. So with the One Big Beautiful Bill, one of the things that I'll mention is the senior tax deduction. So once your AGI passes a certain threshold, you could lose a $6,000 deduction for you and one for your spouse. So if you're in those years, this is only valid from 2025 to 2028. If you have more years that you want to do these Roth conversions, maybe it's better to wait. This also only applies for individuals over 65, so you may not want to do them. You may already be in line with IRMAA. We'll get to that in a second. So if you're already kind of planning with IRMAA and you're already dealing with the senior tax deduction for this One Big Beautiful Bill, maybe it's not worth converting yet. But SALT tax is a really big one. So right now, the SALT cap limit has gone from $10,000 to $40,000. And that historically it limited a lot of people, especially with property taxes, state income taxes, all of that, you're just capped. You've lost your itemized deductions. There is a phase out range. So once you hit, I believe it's $500,000 of income, that then reverts back down to $10,000. You're back at the cap. So you're talking a $30,000 deduction lost if that applies. So it may be worth keeping your income below $500,000 to keep that deduction there. IRMAA premium, Medicare premiums, dealing with IRMAA is probably the biggest thing we navigate in addition to the tax brackets. These first two are a little bit less common. This one is more of a temporary issue. And honestly, you're not going to be doing a lot of Roth conversions after age 65. Not to say you don't ever do them, but it's a lot more rare. And then SALT tax, that's usually for the higher income earners, and you've already passed a lot of IRMAA thresholds. You phased out a lot of deductions. So these two are just a little bit less common. But IRMAA honestly impacts a lot of people. So here are the IRMAA brackets. So what an IRMAA is, it's an income, I'm not going to get it right, but it's income-related medical or Medicare adjusted amount, something like that. Basically, the higher your income goes, the higher your Medicare premiums go. And these are done in bands. So if you're under $109,000 or $218 for married filing joint, you're paying your premium only. There's no additional amount to that premium. Once you pass 218, then you're now in this first band. So you get an additional $81 added to your monthly premium. And then it impacts both Part B and Part D premiums. So this can add up. You're talking $81, let's call it $20 between these two premiums every month. I'm sorry, $100 total. So $100 every month, you're talking over $1,000 a year just by not watching these tax brackets. So if let's say your income this year is $100,000 and you want to do Roth conversions, maybe you limit yourself to $110,000 of Roth conversions to keep your income at $210,000 total. That way you're still staying below this IRMAA threshold, so you don't cost yourself $1,000 in Medicare premiums. So this can be really important to plan. Sometimes the juice isn't worth the squeeze. Maybe it is. You can see, okay, what my tax dollars now versus later. Sometimes it's worth it, but it's worth at least knowing if I jump from 218 to 218.01, you're now paying an extra $1,000, $1,200 a year. So this one is not OBB specific, but it is something that is very important to be aware of. So going through an example here, we're going to just go through an example of 3 different scenarios. One will be no conversions, one will be early conversions, and another one is late conversions. We see a lot of tax filers, they come to us 62, 63, and they say, is it still worth it? I'm going to jump ahead. The answer still is yes in most cases. Obviously, the earlier you plan, the better off you are, the more strategic we can be. Both situations, early or late, are usually better than no conversions at all. So we're going to walk through those so you can see them really side by side. So in this example, I'm going to say you are 55 years old, you've got $1 million in a traditional IRA, and let's assume a 6% annual growth rate. So fairly conservative. This person is married filing joint, and your baseline income before conversions is $100,000. So they're age 55 right now. They want to retire at age 65, and their RMD will start at age 73. So option 1, no conversions. So the IRA grows untouched. At age 65, you have $1.79 million in basically your account balance if you just left it grow. At age 73, you've got $2.54 million. So your approximate RMD is going to be about $95,000. So the tax impact there, your Social Security, your other income, you're now likely in the 24 to 32% tax bracket. So your estimated taxes on that RMD of $95,000 is between $25,000 and $30,000 a year, roughly. So pretty high tax bracket. Your IRMAA, you're bumping up because, like I said, you had $100,000 of base income plus another $100,000 of RMD. So if you have Social Security, any other sources of income, you're likely in that, like I said, 24 to 32% tax bracket, and you're in that next IRMAA bracket. So not ideal. RMDs, like I said, are higher, taxes are higher, and your control is low. You have to take out that $100,000 of income. You want to make the money, but if you can do it in a better way, that's generally more beneficial. So that extra IRMAA costs, like I said, it's probably $1,000, $2,000, depending on which bracket you're in. So in that option, no conversions, you built a good retirement account, but the IRS really is your largest partner. So option 2, early conversions. So same exact base scenario, and we're going to convert $80,000 for 8 years. So once again, starting at age 55, going through age 62. So you've converted $640,000 of that $1 million account balance. And then, so we're going to assume $180,000 per year. We got $100,000 base income plus $80,000 of conversions. You're still in that 22 to 24% tax bracket. Not too much has changed in those early years. And your estimated tax on those conversions, like I said, $18,000 to $22,000. So if you pay that over 8 years, you're talking $150,000 to $170,000 of taxes. So your IRA growth, because you're converting them out, ideally you're paying with outside dollars to pay those taxes, so you don't impact the long-term growth of your Roth IRA. Let's see. But your traditional IRA, it's now worth $900,000 at retirement. So it doesn't sound great, but when you think, oh, I've got another $950,000 in my Roth, those two together, you're talking $1.85 million. If we go back to here, at age 65, it was 1.79. So fairly similar account balances. And then at age 73, your RMD is down to 49,000. So you've essentially cut your RMD down by 50% with these Roth conversions. So your taxes are now controlled. You've paid a lot of them up front at 22 to 24% tax bracket, but you've paid it earlier, spread out over multiple years. Your RMD is much less. So your taxes later on are going to be lower, which gives you more control over your IRMAA. So you're likely not in that second bracket of the IRMAA or even the third one. Your RMDs are low, your control is high. So this is a better situation. The last one, late conversions. So this one, you're converting 300,000 a year starting from age 63 and 64. So you're doing about the same amount in conversions, but you're talking a huge spike in income. The other thing is the IRMAA has a 2-year look back window. So if you're going to retire at age 65 and you're taking Medicare at age 65, they're going to require let's call it 2026 is your first year of retirement. They're going to look back at your 25 and your 24 tax returns to look back at your income. So if you spike those 2 years, your IRMAA has also spiked. So your income tax bracket, you're now 32, 34% tax bracket. Your IRMAA is very high. You phased out a lot of deductions. If your income is $300,000 for those conversion years plus your $100,000, if you have child tax credits, the SALT tax may be reduced at that point, depending on what other source of income you are. But really, overall, you're losing a lot of other deductions. So being reactive, it really does cost you. It's still better than nothing, and I'll show you the overall picture here. So this is the side-by-side comparison. So thinking no conversion, early conversion, and late conversion. We kind of went through this. So the taxes are high, early is controlled, and late is very high. So IRMAA is high, low, very high. But then if you look at the wealth over time, so you got your RMD or standalone, but the wealth at age 85 is probably the biggest indicator of how much you have in that account. So obviously this is very simplified. We want to do a detailed analysis for you, but those early contributions, you're now left with $3.4 million in the account versus 2.8 with the late conversions, or 1.8 if you did no conversions at all. So, and this is a little bit of that trajectory, the wealth comparison over time, as well as the RMD amounts. So a couple of strategies. Make sure you're forecasting your income. A lot of people come to us and they're curious. Should I do Roth conversion? Should I not? Should I do these other strategies? And really, we need to know what you think your income will do over time. Do you expect a 3 to 5% increase at your W-2 day job? Or if you own a business, what do you think your business will do? When do you think you'll sell it? When do you think you'll retire? What is your Social Security going to be? All of these are important factors to take into account. So we need to project the income, figure out what it's going to be, not only this year and the next year, but ideally 5-10 years out, because then we can figure out what brackets are they going to be. And right now, brackets are going to be fairly stable for the next few years. There's always a chance that it's going to change, but we know that there's going to be a cost of living adjustment each year. So we can do a pretty good job at filling those brackets each year. Let's say you want to stay at 12% and below. Okay, we know what the 12% bracket is going to be this year, and we have an idea what it's going to be in the future years. But we can also figure out for the multiple years and these thresholds, what are the IRMAA brackets going to be, the IRMAA brackets, all of these bands that we need to adjust for. We can take your forecasted income and say, how much gap do you have? Because that really leads to one of the biggest issues, is converting too much. We were working with a client this last December, and they were trying to maximize the 22% tax bracket, and even a little bit into the 24. They wanted to stay below a certain IRMAA threshold, so we were working on all of that. And then December 17th, he decided to sell about $100,000 from his brokerage account and convert it from brokerage to a traditional, or to a different account. So he didn't account for about $65,000 of gains in that account. So that converted too much based on the projection we created for him. So make sure you do this as a long-term plan, but you also stick to the plan. If you're going to convert $100,000 and pay taxes on $65,000 of it, the plan doesn't do you any good. You're going to overpay on taxes. So that is kind of my overview on Roth conversions. Hopefully that hasn't been too quick, enough detail for you. So we'll open up for Q&A now. So feel free to, in that footer bar of the webinar window, there should be a question mark in a chat bubble. Feel free to add any questions and I will answer them. So a couple of questions that have come through already. Are there any limits on how much I can convert? So there aren't any limits on how much you can convert from a traditional to a Roth IRA, but just because you can convert a large amount doesn't mean you should. So the key consideration, how the conversion impacts your tax bracket, basically that's the biggest thing, is you don't want to make sure you're over contributing with that tax bracket. Make sure you take a strategic and multi-year approach, just so you can fill up those lower brackets before jumping up to a higher one. So you don't want to go from 12 to 22, for example, or 24 to 32. You don't want to make those big jumps if you don't have to, but that's where a longer term approach can apply. Next question here. When do I need to complete a Roth conversion for it to count for this year? So Roth conversions can be done up until December 31st of the current tax year to count for that year. So pretty simple, December 31st. What are the downsides of doing risks? Downsides or risks of doing a Roth conversion. So the biggest downsides are really just if you're poorly forecasting, you could run into a unexpected tax bill. But really the trade-offs are you're getting an immediate tax bill over a tax bill in the future, thinking Roth versus traditional. You can also impact other areas, like we said, IRMAA, taxation of your Social Security, phasing out of any credits or deductions. They're also irreversible. So once you pull that lever and do a Roth conversion, it is now taxable. So if you don't plan it properly, it could create a short-term cash flow strain. Let's say you do a $200,000 Roth conversion and you have to set aside $40,000 in taxes. If you don't have $40,000 to pay in taxes, that can hurt. Next question here. Will this affect my Social Security taxation? And the short answer is it depends. That's probably one of our favorite answers, is it depends, because it always depends on those facts and circumstances. So Social Security is taxable up to 85% once you hit a certain threshold of income. So most people, it's not going to impact this taxation of your Social Security because your Social Security is likely already taxable at 85%. But if you do have a lower income outside of Social Security, and then you contribute, let's say you convert $100,000, yes, you would need to account for that additional 85% of your Social Security becoming taxable. Should I use cash outside the IRA to pay the tax? Yes, that's generally the preferred strategy. If you have more strain on your cash flow, if you don't have any outside sources of cash, you don't have to. You can basically cash out from the traditional IRA, convert a portion amount. If you're under 59.5, there could be early withdrawal penalties if you don't do it directly over. But basically, if you take cash from an outside account and you convert from the traditional to a Roth, you're maximizing the long-term compounding power of the traditional to Roth conversions. So usually in general, a outside cash is generally the best way to do it. And I don't see any other questions coming in. So if you guys have any other questions, feel free to send us an email. I'll bring that up here. We've got our email and phone number here. If you're a business owner looking to learn about our services, feel free to scan this QR code. We'd be more than happy to meet with you for a free needs analysis. We can look through your bookkeeping, we can look through your taxes, see if we can come up with any strategies, or even just get to know you, see if there's any way we can help. Like I said, next week is our last Tax Tuesday of tax season. We will continue on a monthly basis after that. So feel free to bring any questions and you can shoot them in via email. Have a great day.